Alright, so now we are going to be present about our advanced financial management assignment, and my name is Yong Kin. So first, I'll introduce about Singapore. So Singapore is a major financial hub in Asia, which is the third largest forex center globally, and it has stable economy, strong legal system, and also financial infrastructure that attracts global investors. Therefore, Singapore is highly exposed to global risks such as exchange rate fluctuation in commodity prices, and also fluctuation in interest rate. So Singapore will use derivatives such as futures, forward, swap, and options contract for hedging, speculation, and arbitrage purposes. So for future contract, it is a standardized agreement to buy or sell an asset at a set price and future at a future date. So its purposes include hedging and speculation. So in terms of hedging, future contract is used to protect against price fluctuation. For example, farmer will enter into future contract to lock in the price of the crop. And in terms of speculation, it is making profit opportunity from anticipating price movement. So for example, traders will buy low and sell high. And there are two types of future contract that are being traded in Singapore, which is the commodity futures, which include oil, gold, and agricultural products, and also stock index futures, which include S&P 500. And from the future contract, there is a case study, which is the Brent crude oil futures on SGX. So SGX is a Singapore trading platform, and SGX has launched Brent crude futures to tap into Asia's oil trading demand. And Brent crude oil is a global oil benchmark that is priced in USD per barrel. But there is downfall for this future contract traded on SGX. So after the initial promise, the contract was still delisted in 2002 due to three major reasons. So the first reason is drying liquidity, where the trading volume and open interest have been steadily declined, and the market liquidity has become insufficient to sustain for its operations. Next is ICE dominance. ICE is Intercontinental Exchange, which is a global trading platform, and it has a more deeper liquidity, and traders are more preferred the established platform by ICE. And the third reason is cost issue, where the widening bid and ask spread has made the trading to become more expensive, and there is no price advantage trading on SGX compared to trading on ICE. So from the future contract case study, we can conclude that there is advantages and disadvantages for future contract. So in terms of advantages, no physical delivery needed, which means that the future contract is cash settled and the traders doesn't need to handle any asset. And next is leverage. Traders can control a large positions with a relatively small capital. And lastly is high liquidity. Traders can easily enter or exit into the markets. But in terms of disadvantages, it is high risk, where the leverage can magnify the losses in the volatile markets. Next is transaction costs. Fees such as bid and ask spread can reduce the trader's profit. And last is complexity. Traders are required to have a deep market knowledge to trade future contracts, or else they would just be making losses easily. And that's all for my part. Thank you.
Alright, so now I will continue the presentation with the forward contract. So let's begin with the basis of the forward contract. So a forward contract is a customized agreement between two parties to sell or to buy an asset at a specific price for the delivery at the future date. So the buyer is known as the long position while the seller is a short position. So the forward contract are commonly used in the financial market to hedge against the risks, like for example, the exchange rate fluctuations, the commodity price changes, and also the interest rate movement. For example, the company often use the forward contract to lock in the exchange rate for future transactions. And at the same time, the forward contract also can be used for the speculative purposes if the trader have a clear outlook on the market trends. Okay, now let's move to a real-world application of forward contract in the Singapore's electricity market. So that Singapore has highly concentrated the electricity market, and the forward contract have become an important tool for independent retailer to manage the price volatility and remain competitive. Like for example, in April 2015, the Singapore Exchange has launched a wholesale electricity forward market. So these are quarterly base load contract and settled against the universal supply electricity price, which called USEP. And each contract representative 0.25 megawatt hour every half hour over a quarter. So this mechanism provided the transparency and also the liquidity, which can make it possible for smaller independent retailer to enter the market and compete with the established player. Okay, so how do the retailer actually use the forward contract? So the retailer will buy the forward contract to lock in the wholesale electricity prices for the upcoming quarters. So by doing so, they can offer the fixed price packages to the customer, especially the large commercial and the industrial user who value stability. Like for example, in June 2015, an independent retailer could lock in the fixed price for around 1,100 megawatt hours covering July to September. So this protected them from the price increase which caused by the high LNG cost or surging demand for the air conditioning, especially in the hot season. So this strategy made it possible for the smaller or the new retailers to compete in the market without needing to own expensive power generation asset. And next, I will continue with the advantages and also the disadvantages of the forward contract. So the first major advantage is that they can enhance the retail competitions. So the independent retailers can now compete without investing in a costly power generation asset, and this lower entry barrier forced the existing retailer to reduce the price, which made the market more competitive. And the second advantage is the forward contract provides this price stability for both retailer and also the consumer. So by locking these wholesale prices, the retailers can offer the predictable and stable electricity packages. So this stability is very important, especially for the Singapore's commercial and also the industrial sector that rely on the accurate budget planning. So the last advantage is the forward contract have contributed to a reduction in the wholesale prices, so that the retailer with the forward obligation tend to bid closer to their marginal cost, so which has resulted in the wholesale electricity prices falling by about 10 to 20%. So for overall, the forward contracts benefit both market and consumers. However, while the forward contract provided many benefits, they also come with some disadvantages. So the first disadvantage is the opportunity cost due to the price invisibility. So the retailers locked into the fixed price may lose out when the wholesale electricity price drop to below the contract rate, which means that they will miss the potential saving. So the second disadvantage is the counterparty risks. So since forward contracts are not standardized, so there is always a chance that the counterparty may default. Even with the regulatory oversight in Singapore, the independent retailers still need to carefully assess the financial strength of their counterparties. So the last disadvantage is there is dependence on the market liquidity. So the forward contract work well only if there is enough trading activity in the market. So if the liquidity is low, the smaller retailer may struggle to secure sufficient contract volumes, which will make it more harder for them to compete effectively.
Swaps are financial agreement between two parties to exchange cash flow or asset. The main purpose is to either hedge against risk or to speculate on market movement. Swaps are very flexible as it can be customized depending on the needs of the parties. The most common types include interest rate swap, currency swap, commodity swap, credit default swap, and equity swap. In practice, the most important types are interest rate swap and currency swap. I will focus on. In Singapore, interest rate swaps are mainly used to exchange fixed rate payment for floating rate payment. The floating side often use the swap offer rate, also called SOR, and there is also an overnight interest rate swap market known as OIS. Singapore's swap market is linked with the United States, so interest rate movement in both countries are closely connected. The benefits are clear. Company can manage risk by fixing borrowing costs, and they can reduce volatility, and they also can improve their market liquidity. Arbitrage opportunity may also appear when there are differences in the rate. For example, if the spread or gap between Singapore and US rate become narrow, it encourages more cross-border trading, improve liquidity. Currency swaps involve exchanging principal and interest rate payment into two different currencies. They are mainly used to manage currency risk, stabilize cash flow, or to access cheaper funding in foreign currencies. The process is simple. First, the two parties exchange a currency, then during the swap, each pays interest in their own currency. At the end, they swap the principal back. And a good example is a currency swap between Monetary of Singapore and the Bank of Japan. This agreement renewed in 2022 and valid until 2025. It allowed up to 15 billion Singapore dollar or 1.1 trillion yen. The benefits are significant. It protects Singapore against exchange rate fluctuation and ensures foreign reserve, provide cheaper access to foreign funds, boosts confidence in trade and investment, and also it strengthens ties between Singapore and Japan. Although swaps bring many benefits, there are also disadvantages. First, there is counterparty risk. That means both parties need strong and trust partner. Second, in Singapore, private swaps are not cleared through a central clearinghouse, which increases the risk. Third, swaps have limited liquidity, meaning they are hard to cancel or transfer once agreed. Finally, they are complex contracts and difficult to value in the long term. So, while swaps are powerful tools, they must be used carefully.
Next is the option contract. Option contract is essentially a financial agreement that gives investor a right but not an obligation to buy or sell underlying assets at a fixed strike price within a specific time frame. As financial markets have become more complex and volatile, options have grown in popularity as tool for both hedging against risk and speculating on price movement. There are two main types: call option, which allow buying the assets, and put option, which allow selling it. To obtain this right, investors should pay the option premium to the seller. Option also can serve multiple purposes like protecting against potential loss, taking advantage of expected price change with a smaller upfront investment, or even generating income. In Singapore, option trading serves multiple purposes for managing investment risk to generating profit. Investors can trade options on the Singapore Exchange, which cover local assets, or through international broker for access to global market. The Monetary Authority of Singapore regulates this activity, ensuring transparency and security for all participants. Historically, Singapore played a pioneering role in Asia derivative markets. Back in 1988, the Singapore International Monetary Exchange, known as SIMBX, became Asia's first financial future and option market, designed to serve both local and international clients. To boost financial efficiency, SIMBX worked with the International Monetary Market Division of the Chicago Mercantile Exchange under a netting arrangement. This partnership helped maintain continuous liquidity and healthy trading volumes, positioning Singapore as a key risk management hub in the region. Option contract can offer three main advantages in Singapore. First is capital efficiency and leverage. Instead of buying the underlying assets outright, investors only pay a premium for call or put option, and they can gaining substantial market exposure with a fraction of the capital. This can free up their cash for other investment and allow for greater portfolio diversification. And the second is the balance of lower risk with high reward. In times of market volatility such as earning announcement, policy change, and geopolitical events, option can deliver significant returns. For buyers, the maximum loss is limited to the premium paid, while the potential gains can be substantial. Profit can come from rising, falling, and even sideways market, making option attractive to both retail investor and caution trader. And third is hedging. Exporter, importer, and financial institutions in Singapore can use currency and interest rate option to manage fluctuation in exchange rate, interest rate, and equity price. For example, a company exposed to a weakening foreign currency can use a put option to secure a favorable exchange rate and protecting their revenue. Similarly, equity investors can buy put option to guard against potential stock price deadline without selling their holding. However, option trading still has some disadvantages such as complex. Options require knowledge of strike price, time decay, volatility, and trading strategy, as well as SGX rules and MAS regulation. Option sellers in particular face potential unlimited loss in volatile markets and must maintain the margin account, which may involve large collateral and interest costs. While Singapore does not have tax capital gains for individual investor, frequent traders may be taxed if their activity is deemed a business by the Inland Revenue Authority.
Okay, so here are some of the recommendations for the Singapore derivative market. So the first one is the Singapore should focus on the educations. This is because many investors and the companies find the options and the swaps contract hard to understand, with the risks like the time decay and the counterparty default. So the monetary authorities of Singapore, which is MAS, together with the banks, can provide simple brochure or the online courses. And this should explain that the futures contract, forward and swap, and also the option contract in an easy way. So while also warning about the possible losses. So the next recommendation is the Singapore should strengthen rules for the counterparty risks, especially in the forward and also the swap contract. So since these are private contracts, so that is always a chance that one party does not deliver. So the MAS can reduce these risks by checking the financial health of the party and asking for the collateral, like the option seller do. So a central clearing system similar to the future can also make the forward trader trading more safer and also more trusted. So the third recommendation is that Singapore should promote greater transparency in the derivative market. So this means requiring more detailed reporting, such as the trading volumes, underlying asset, and also the positions. Like for example, in the swap contracts, both parties should disclose their risks clearly, and this can help the regulators monitor the market and prevent the manipulations. And the last recommendation is the fintechs already makes derivative trading more easier and faster. So with the real-time analytics, the traders can manage the risks more efficiently. However, as the digital trading grows, so does the risk of cyber attacks. So the Singapore should set higher cyber security standards, require a regular IT audit, and work with the international security bodies. So this can significantly protect the investor and strengthen the Singapore's position as a safe and modern financial hub.
In summary, Singapore is a leading financial hub with a strong legal and regulatory foundation, supporting a vibrant derivative market that includes future, forward, swap, and option. Each serve a unique purpose, whether it's managing risk, improve capital efficiency, or capturing market opportunity. Future contract bring standardization and liquidity. Forward contract allow customization, swap manage interest rate and currency risk, and the option offer flexible with controlled downside. However, this instrument also carry risks such as counterparty default, liquidity issue, regulatory complexity, and leverage-related losses. Ultimately, derivatives are powerful tools in Singapore's financial landscape, but their real value comes when they are used strategically and with sound risk management.